You wake up one day, check your bank account, notice your mortgage, your student loans, that small interest line you barely understand, and yet somehow all of it is being quietly decided by a few numbers you'll never see. Interest rates. Sounds boring, right? But here's the thing. These numbers don't just sit in a report somewhere. They move houses. They crash markets. They quietly decide whether your paycheck buys you a car or barely covers rent. And most people have no idea how the game really works. Let's start with the basics. Banks don't set interest rates. Central banks do. In the US, it's the Federal Reserve. Twice a year, they meet behind closed doors. They sip coffee, they debate, and then they announce, we're changing the target rate, a few decimal points. Tiny numbers. But here's the kicker. Those decimals ripple across billions of dollars, affecting mortgages, credit cards, student loans, and yes, your life. Why? Because banks borrow money from each other, and when the Fed changes rates, it changes the cost of borrowing. That cost then trickles down. Your mortgage goes up. Your savings account interest changes. Even your favorite credit card might charge more. But here's where it gets weird. It's not just about your money. It's a game designed to control behavior without you knowing it. Raise rates, people borrow less. Businesses slow down. Economy cools. Lower rates, people spend. Businesses expand. Economy heats up. It's a thermostat, only it's not in your house. It's in the global economy. And yet, the math behind it is less precise than you think. The Fed uses models, predictions, past trends. But human behavior is messy. People panic. Markets overreact. Sometimes the Fed shoots too high too fast, sometimes too low, and the results can be catastrophic. Take 2008. Leading up to it, interest rates were kept low for years. The idea? Make borrowing cheap, fuel growth. The reality? Housing prices soared, debts piled up, banks failed, and millions lost their homes. Tiny changes in rates, decided by people in a quiet room, sent shockwaves across the globe. Now let's zoom in closer. Your credit card. You owe $5,000. The interest rate is 18%. You think you understand what that means. You don't. Every month, the bank calculates interest daily, using a formula most people never read. You pay $100 one month. Next month, the interest has already been compounding on a slightly higher balance. That small number, it quietly grows faster than most paychecks. Even savings accounts aren't safe. The Fed drops rates to 0% to stimulate the economy. Sounds good, right? Except your savings now barely earn anything. Meanwhile, inflation silently eats away your purchasing power. You're earning less even as the numbers in your account go up. It's ironic. The system is designed to balance growth and stability, but it often punishes ordinary people more than anyone else. Big corporations hedge. They borrow strategically. They play the rate game. You get a bill. And here's the uncomfortable truth. The Fed isn't always reacting to the economy. Sometimes it's reacting to the markets themselves. They watch traders, they watch investors, they adjust rates to calm or excite market behavior. It's a loop. Your life is subtly nudged by invisible feedback you can't control. So, what's the takeaway? Interest rates aren't just numbers. They're levers, invisible levers. Pull the wrong way and entire industries shake. Pull the right way and markets soar. But here's the final twist. No one really knows the perfect level. The game is ongoing. Risk is constant. Next time you glance at your bank statement, your mortgage, or your student loans, remember a tiny decimal decided months ago could already be shaping your next 5 years. And the people pulling those levers, they're playing a game most of us will never see. So, the question remains, who really wins and who just keeps paying for the game?